matching. So how you expense the match? The only thing is you need to match the expense when you are recognizing the income. Okay, that is the only important point in expense matching. Means whenever you are earning the income, you need to recognize related expense. You pay or you don't pay. Otherwise, you defer your revenue to actual expense whenever you need to make the expense. Okay. Okay, the rest is not really important. And you need to differentiate between your capital and operating expense and non-operating expense. Okay, operating expense and non-operating expense are, I explained to you previously, right? You can have different operating expense means to justify different models, different business model you're using. And non-operating expense are, if you don't separate, non-operating expense means your interest, your rental of the property where you are doing the business. It doesn't affect your business performance. You own the building or you rent the building. It's the same thing, right? But from an operating perspective, as a business, you need to know what is my operating profit so that you can compare with other businesses. So you need to understand what expenses are making an impact on business performance, not on your profitability. Profitability, yes. If you pay the rent for this building, you have to have a less income. But from an operational perspective, it doesn't matter you own the building or you rent the building, right? It's a different business model. So you have to understand what is operating expense for me, what is non-operating expense for me. So that you can understand, is your business making enough operating income or not? Okay. So large expenses does not mean that it's capital. Some people they say, oh, I spent $100,000 is a lot of amount to spend on profit and loss. But amount does not qualify for capital expenses. Intention and the usage. Okay? Yeah, not yet the last. Cost center. I also don't know what else I put it here. Okay. So cost center accounting means you need to identify your significant departments or significant contributors of revenue and match the revenue and expenses to each profit center. Okay, for example, maybe in a hotel, where the money come from? We sell rooms, we sell outlets, we have spa, we have transportation, right? So for us, every department is a separate department, separate profit center. So we want to understand the profitability of each and every one separately, so that we can shut down the one which is not profitable to maximize our business, right? In the beginning, I gave you an example of 10 different businesses. Maybe 2 are making loss, 8 are making profits. So you may want to do something with the one which are making loss, but you need to identify them first. So there will be some costs which are common. For example, one CEO is managing all the businesses. So how will you identify the business? Cannot, right? You cannot identify the time spent by the CEO on each and every business. You're not recording the timesheet. So there are certain costs which are common, like brand, building rent, CEO expense. But there are certain expenses which can be identified, like specific marketing expense, specific revenue, specific cost of sales. So at least if you know that, you will know the business or the profit center's operating capacity. Okay. Common expenses you cannot segregate. If you cannot segregate, just keep them together, which is not necessarily you have to put into. Otherwise, if let's say you say, okay, the CEO will be charged 1/10 in every business. In actually, if some business is very low income, even though he's making money, you will say this is not profitable anymore, because after charging the salary of CEO, this profit center does not make any money. So shut down that business, which is not correct. Without charging the common expenses, he's still making money, right? So it's contributing to the salary. So you need to understand that what are the fixed and common expense and what are the specific expenses to the business. Okay. Okay. Control aspects of AR means you need to have a credit approval system for your business. Businesses can make credit sales. So you need to know who are our customers and how we control. You are not giving credit to every single body, right? Not everybody who is going on the market can come and say, I will give me the money, give me the services today, we'll pay you tomorrow. Do you think that person will come back tomorrow? Maybe not, right? So you need to have a control system, credit approval system, on time billing and serialized. So the billing need to go on time and it need to have a serial number to make sure that even your own staff are not cheating. Maybe they give you the, maybe they sell something and they took the money in cash and pocket it. So as the owner, you will not know, right? I have seen the cash collection controls, cash collection frauds. The company, the person who go out in the cash and collect the cash, he can mess up your cash collections. I have seen a fraud of up to like $2 million. Somebody who did a fraud of $2 million while only the cash collection. So it was not, he was not even the highest position staff in finance, where only the bill collector. He go and collect the money and doesn't report to the company because the company didn't give him the serialized controls and they don't ask him. And so how the money, because this customer is not paying, right? So how he does it? He manage, he take money from one customer and put into another one. Take money from this customer and say, okay, this person already collect. So whoever is overdue, he adjusts the first, but keep all the money with himself. So he's not reporting the money to the company. After a while, he spent all the money. So now the company lost $2 million. And finally, the provision for bad debt means once you review your customer, you need to understand who is going to pay us, who will not be able to pay. So you need to recognize your expense timely. Earlier you recognize is better for you, right? Okay, advances are similar, means normally we don't look at it. Once we pay the advance, normally you need to receive the services, right? But this is something which we normally don't do. We don't know how many advance we have given and have we received the services or not, because there is no register, there is no control on the aspect. So you need to have like an advance register where you are recording how much money you are paying in advance to whoever, and have you received the services which they were supposed to give or not, and have it reviewed like every 3 months, every 6 months, to make sure nothing is pending for a very long period of time. When I normally start any new job, I first go and check what are the pending advances being there. So normally what I find is, oh, for 4 years we paid the advance to a certain company and we have not get the money, or we are not getting the services. So what does it mean? You pay the advance, the supplier go, and you lost your money, right? So that normally happens in every business. Okay, then what is working capital? The money that you need for your day-to-day business, right? Maybe your daily or monthly cash requirements, amount that you need to make for purchasing the raw material. So you need a lot of money to run the business, right? So normally assessment you do based on either your cash flow, how much money you need to spend on a daily basis to survive the business, how much credit sale you need to do, how much supplier you can get on credit, what you can buy on credit, what you cannot buy on credit, right? And how much inventory you need to keep in your stock all the time. So that becomes your working capital. So you need to estimate and make sure you have it all the time. Okay. So normally you have a higher cash conversion cycle, means you normally buy a material until it's sold. It's called inventory days. And once you collect from the selling until you collect the money is called receivable date. Total becomes operating cycle. Okay, but you don't need to pay for your inventory all the time. So that becomes payable days till the time you pay your suppliers. So the balance is called cash conversion cycle. So our objective in working capital management is to reduce this cash conversion cycle. So how you can reduce it? Either try to sell faster. If you're not able to sell faster, collect faster. If you are not able to collect faster, pay your suppliers late, right? If you pay your suppliers late, you can manage your cash conversion cycle to be the lowest. Otherwise, you have to, if you are paying too fast and you are collecting very late, you need a lot of money to survive in your business, right? Which is very difficult, especially for a new company or which does not have enough capital. Okay, so our objective is to minimize this cash conversion cycle. So you need to identify first where the cash conversion cycle what is the cash conversion cycle, what are components, are we selling too late, Are we collecting too late or we are paying too fast? So either you sell faster, you collect faster, and you pay late. Then your cash conversion cycle is reduced. You know what is the cash conversion cycle of Apple? Apple company. Apple, minus 60 days.
60 days.
Minus means because they sell very fast in advance mostly. They don't sell on credit. Okay, you have to pay the money in advance. But they pay their supplier after 90 days. So their cash conversion cycle is actually they are actually getting finance from their suppliers. They don't do that. And sometimes company can have a cash conversion cycle up to like 90 days. Means sometimes they take a long time to sell. And if for example like Samsung has a higher cash conversion cycle. Why? Because Samsung made a lot of product. Their product sells slower than Apple, and they sell on credit also. They sell to the dealers, which pay them money later, and they pay their suppliers comparatively faster than Apple. So they have a positive cash conversion cycle, means they need money to run their business. While on the other hand, Apple, they don't need money to run their business. They run their business from the supplier money. So they get the material first, they pay them later. But whatever they sell, they can get the immediate cash. So our target is to have negative cash conversion cycle, or at least the lowest possible. Okay.